This is TechCrunch.
The energy transition is seemingly under assault, with congressional Republicans killing tax credits for clean energy and the Trump administration threatening to cancel billions of dollars worth of grants. But there are signs the setback might not be as catastrophic for the transition as the headlines make it sound. Investor sentiment, which, judging by the size of two new funds, remains strong, and more founders are pouring into the sector. The upshot: people and organizations are betting money and time that the energy transition isn't going away. This week, Brookfield announced it had raised $20 billion for its second energy transition fund. The infrastructure investor has already deployed $5 billion of that money into renewable power projects and developers focusing on solar, wind, and battery storage. Perhaps more notable is the fact that Brookfield raised 33% more money this time around than it did for its first transition fund in 2021, when 0% interest rates and a frothy economy led some to speculate that clean energy was entering a bubble. This second, larger fund raised in a less exuberant period suggests that limited partners see durable growth ahead. Also this week, Energy Impact Partners announced it had closed its third flagship fund with $1.36 billion in commitments, some 40% larger than the previous one. According to PitchBook, EIP is a venture fund that invests after early-stage startups prove their mettle. The median size of a round it invests in is $26 million. Climate tech has seen an uptick in new founders flocking to the sector over the past 5 years, driven by a changing climate that became too hard to ignore for many. Not all of those will have survived, but enough have made it that investors see opportunity in funding the next stage of their growth. Already, EIP has deployed about a quarter of its new fund to companies like Grid Beyond, which helps manage distributed energy resources, and Quilt, a consumer-facing heat pump manufacturer. Investing trends that have developed the past decade remain strong. Since 2014, large LPs like pension funds and endowments have committed nearly $1 trillion to the energy transition. And while climate tech VCs are on track to raise about as much as last year, they're outpacing the broader venture world, securing a larger percentage of commitments. According to PitchBook, this year they've raised 3.8% of all venture capital, nearly double their share in 2020. In the U.S., there are headwinds in the near term. The Trump administration is openly opposed to the idea of an energy transition, and it is doing its best to undermine what progress has been made. As a result, the International Energy Agency has revised downward the forecast for renewable adoption in the U.S., predicting that the rollout between now and 2030 will be 45% lower than the agency had predicted last year. Despite that, renewable capacity worldwide is expected to double by 2030, led by solar installations in China, India, the EU, and sub-Saharan Africa. The IEA isn't the only organization predicting that the transition will continue. Analysts at DNV expect that renewables will provide 65% of the world's electricity by 2040 and nearly all of it by 2060. It won't be enough to hit net zero carbon emissions by 2050, DNV said. But few transitions are without their ups and downs, and the momentum appears to favor more renewable energy, not less. The United Kingdom's Competition and Markets Authority on Friday designated Google with a special status in the market for online search that would enable the regulator to enforce stricter regulations. The CMA has designated Google as having strategic market status in the search and search advertising markets, which means the company has such a substantial and entrenched position that it requires special regulations to ensure fair competition. The CMA wrote in its report that Google has had an unparalleled position in this digital activity for an extended period. Other traditional general search providers are significantly smaller than Google and have been for many years. Bing is the largest of these providers, but its current shares of queries and search advertising are both less than 5%. No traditional general search providers have materially grown relative to Google for at least 15 years. Although the designation does not mean that the CMA has found evidence of wrongdoing and does not introduce any immediate requirements, It does open the gates to launch further assessments and introduce interventions to change how Google runs its search services in the country. The designation covers Google's search and online search advertising services, its AI-enabled search features like AI overviews and AI mode, and the Discover feed and results, as well as the top stories and news tab. It does not cover the Google News app and website, and search syndication services are also out of scope. The CMA, however, noted that while Google's Gemini AI assistant isn't covered by the designation at the moment, it will review the scope of the designation given uncertainty over how the AI search market is evolving. The regulator said it would launch a consultation on possible interventions later this year. The move follows a 9-month investigation into the company launched earlier this year after the UK's new digital markets competition regime came into force in January. The CMA was looking to prove if Google is enabling weak competition and barriers to entry and innovation in search, whether the company prefers its own services over those offered by third parties, and if it uses consumer data without their explicit consent. The CMA's roadmap of possible enforcement actions may include enabling UK residents to choose and switch search engines via choice screens, implementing data portability systems, enforcing fair ranking of search results, ensuring proper attribution of publishers' work in search, and enabling consent mechanisms for Google's AI services. Google, for its part, says that any interventions following the designation would harm innovation in the UK. The company wrote, "The UK enjoys access to the latest products and services before other countries because it has so far avoided costly restrictions on popular services, such as search. Retaining this position means avoiding unduly onerous regulations and learning from the negative results seen in other jurisdictions, which have cost businesses an estimated €114 billion. Many of the ideas for interventions that have been raised in this process would inhibit UK innovation and growth, potentially slowing product launches at a time of profound AI-based innovation. Others pose direct harm to businesses, with some warning that they may be forced to raise prices for customers." That's it from TechCrunch. For more tech stories like these, go to TechCrunch.com.